Daily Fiscal Pulse for the 7th of August, 2026. Covering Friday's trading. These are settled figures, not real time, so keep that context in mind as we move through the data. Let's start with what's capturing market attention right now. AI and technology remain the dominant narrative. We're seeing headlines like Nvidia lining up $500 billion in financing, with CEO Jensen Huang discussing chip capabilities on CNBC. That's clearly influencing price action today. Of course, market narratives can shift quickly, but what matters most is where the actual flows are going. Turning to the fiscal picture, we saw a net transfer of $3.6 billion. Standing alone, that looks reasonably stable. The real story though is the directional shift in shorter time frames. The 5-day average has dropped to roughly half of what we've observed in recent weeks. Tax receipts are doing the heavy lifting here, coming in at $10.0 billion. The ES is telling a somewhat more optimistic story than the flow data alone would suggest. E-mini S&P futures settled at 7,778, maintaining ground above the 20-day moving average which sits at 7,561. Over the past 20 trading days, we're looking at a range of approximately 474 points. Price is holding up despite the fiscal headwind we're tracking. Day-to-day moves are interesting, but the trend is what really drives outcomes. Government spending on a 5-day basis is averaging around $2.1 billion daily. Put that against the 20-day average of $9.4 billion, and you see a clear deceleration. Less liquidity flowing into the system means less cash circulating through households and into the broader markets. The tightening is showing up in financial conditions. Year-to-date numbers tell the same story. Fiscal year-to-date spending stands at $1,467.8 billion. That's approximately 12% below the same period from a year ago. It's a material pullback in fiscal support, and that matters for system-wide liquidity conditions. Anyone considering risk exposure needs to account for this fiscal headwind. We're not looking at tailwinds here. Our conditions gauge is reading -70. That said, history provides some perspective. We've seen setups like this many times, and despite tighter liquidity, the S&P has still averaged around positive 1.5% over the following month. Markets don't necessarily move in lockstep with liquidity flows. They can grind higher even when conditions are constrained. Positioning is something to watch carefully. Margin debt is currently sitting at the 100th percentile, which is elevated. Historically, those kinds of levels function more as a warning than as a signal to buy. How does this translate to market behavior? With fiscal flows running below year-ago levels, there's less of a cushion built into the system. When headlines are constructive, markets can still inch higher, but if a risk event erupts, whether it's escalation in AI or tech volatility, the downside can accelerate more sharply because there's less liquidity in the background to cushion the move. Looking ahead at what could shift the setup, the 12th of August brings the SSA payment cycle, the second Wednesday of the month, and that tends to move short-term flows. Around the 15th of August is when the next major Treasury coupon interest payment window opens. Fiscal drag is definitely visible in the data. What we may be seeing though is a stabilization in the pace of that tightening. The next meaningful move probably hinges on how these scheduled flows settle in. That's the picture going into the next session.